Welcome to this explainer. Today, we're unpacking something absolutely crucial: how sustainable investing is no longer just some corporate buzzword. Actually, it's become a vital shield for your portfolio. If you've been watching the markets lately, well, you know volatility is just the name of the game right now. Between supply chain shocks, crazy changing regulations, and shifting consumer demands, things are constantly getting shaken up. So today, we are zeroing in on ESG investing. We're going to explore how evaluating a company's societal and environmental footprint has completely evolved. It's gone from a nice-to-have, feel-good PR exercise into a hardcore, essential metric for risk resistance and long-term competitiveness. We're going to dig into the data that proves exactly why this framework is critical for anyone who wants to build a truly resilient portfolio. Okay, here's our quick roadmap for today. First up, redefining ESG. Second, the 3 ESG advantages. And third, creating win-win investments. Let's dive right in.
All right, starting with Section 1, redefining ESG, we need to look at the modern view of this concept. For the longest time, the traditional view of finance relied on a really simple question: how much profit did this company make? The focus was strictly on quarterly earnings, revenue growth, and those standard balance sheets. But as we all know, profit doesn't just happen in a vacuum. The modern ESG view recognizes that to figure out if a company is truly resilient over the next 10 years, we have to look a lot deeper. We literally have to analyze their exposure to climate change transition risks, what their labor rights track record looks like, and the level of transparency going on within their board of directors. These aren't just ethical choices anymore. They are the absolute modern markers of a company that's built to last. I mean, think about it. If a business is generating massive profits today, but relies on a heavily carbon-intensive process that's going to be regulated out of existence in 5 years, that profit is just an illusion. That traditional balance sheet is hiding a massive amount of unpriced risk. So, breaking it down, these 3 pillars, environmental, social, and governance, have to act as equal, interconnected foundations. Our sources emphasize something really important here. A company might have these incredible green initiatives and zero-carbon targets, but if their board is corrupt, or if they face continuous labor strikes because of terrible working conditions, their foundation is ultimately going to crumble. You can't just pick one metric and totally ignore the others. It's the integration of all 3 of these dimensions that gives us the true, full picture of a company's overall health. Honestly, think of it like a 3-legged stool. If just one leg is rotten, the whole thing completely collapses under pressure, and it takes shareholder value right down with it. That holistic view is exactly what modern risk assessment requires. Moving on to Section 2, the 3 ESG advantages. Let's talk about how to defend your portfolio and your bottom line. It turns out, ESG acts as a literal defensive shield for your investments. Our sources highlight 3 distinct financial advantages that you get from integrating these metrics: lower systemic risk, long-term return stability, and a massive capital flow advantage. So let's break these down one by one to see exactly where the theory turns into tangible, hard financial protection for your capital. First off, real-world regulations are actively turning bad environmental practices into severe financial penalties right now. Take the EU's Carbon Border Adjustment Mechanism, or CBAM, for example. As global regulations tighten up, companies that are failing to meet sustainability standards are basically walking straight into immense fines and massive transition costs. We are not just talking about a little slap on the wrist here. We're talking about tariffs that can completely wipe out a company's entire profit margin on exported goods. By utilizing ESG criteria, you're proactively filtering out the companies that are carrying these hidden legal and policy risks. You're effectively sidestepping a giant financial landmine before it ever even has a chance to detonate in your portfolio. Now, this naturally leads us to the absolute most common question skeptics have about sustainable investing. Does doing good actually mean making less money? It's a super understandable assumption, especially if you were raised entirely on traditional finance, where the assumption was always that any internal investment in sustainability or employee welfare was just an automatic drag on profits. Well, the data proves the reality is actually the exact opposite. Companies with high ESG scores simply operate way more efficiently. Think about it from a practical standpoint. Superior corporate governance drastically reduces the risk of fraud, regulatory fines, and mismanagement. And those things are notorious shareholder value destroyers. On top of that, genuine social responsibility hugely boosts brand value and keeps top-tier talent from jumping ship to the competition. Employee turnover is incredibly expensive, right? When a company retains its best people and avoids costly scandals, those operational efficiencies compound year after year. This directly feeds into that long-term return stability we're all looking for.
proving for sure that strong governance and risk management translate directly to the bottom line. And hey, always follow the big money. Institutional giants like global pension funds and huge sovereign wealth funds, they now use ESG as a core filter for their capital allocation. This creates a really powerful liquidity safety net. We are talking about trillions of dollars here. When massive institutional capital floods into sustainable targets, it provides incredibly strong value support. What that means is, when market panics inevitably happen, these stocks often see way less downside volatility. Why? Because the largest, most stable players in the entire market are holding them for the long term. You aren't just investing intelligently, you are literally investing alongside the biggest, most stable money in the world.
Okay, let's bring it home with Section 3, Creating Win-Win Investments. Here are some practical steps to capture these macroeconomic advantages. Instead of pulling your hair out trying to pick single stock winners and perfectly timing the market, the most effective way to participate is actually super straightforward. First, you just utilize ESG ETFs or sustainable mutual funds. And doing this triggers step 2 automatically, which is diversification. You immediately hold a broad basket of top-performing companies across a bunch of different sectors, completely insulating your portfolio from the wild, unpredictable swings of single stocks. This strategy naturally filters out the laggards and concentrates your capital right into the forward-thinking leaders. Ultimately, this leads to the ultimate double win. You get to pursue robust personal wealth growth, all while using the sheer power of your capital to support the exact companies that are pushing the global economy in a much more resilient, sustainable direction. I want to leave you with one absolutely critical thought today. In a rapidly changing market, is your portfolio resilient enough to survive tomorrow? The rules of global business are fundamentally shifting right beneath our feet. Climate policies, labor expectations, supply chain transparency, governance standards, they are all evolving faster than ever before. If your strategy completely ignores these environmental, social, and governance factors, you might be carrying way more risk than you realize. You might actually be investing in the economy of the past rather than the economy of the future. I really hope this explainer has given you a powerful new framework for analyzing your portfolio. Thank you so much for joining me, and keep learning.